market talk, uh, I'm going to take a reference of cricket only. Robustness requires firm historical basis to the entire method. How to become a good test batsman. So uh, if you see below, there are photographs of three the best Indian test batsmen who had the best technique: Gavaskar, Tendulkar, and Dravid. So the point is, method works. Only thing is that you have to pull it off. And why I put the photograph of two young guys above that is that they can learn this from these guys where the method works. So we need to see what method works for others or what has worked historically for the best in this in the past, and then try to implement it to be successful in the market. So if you see, taking example of cricket, the best batsmen have all adhered to classical batting techniques, and perhaps that is the approach for the young people to follow. Though Sehwag or Pant may disagree, but we need to find the method that works for most and not the exceptions. And always the valuations and return on capital employed are the key metrics to employ, while one has to be careful with excessive debt, constant equity dilution, corporate governance, promoters who always try to fleece the minority shareholders, and the quarterly or the yearly numbers that smell bad. They don't add up. So these are the things to avoid. So we need to draw a Lakshman Rekha kind of thing for ourselves, which we don't cross in times of overexcitement in a frothy market. Now, key issues which will determine movement of equities. Overall, corporate results so far suggest that this earnings season isn't going to set the bosses on fire. Results of Nestle, Bajaj Auto, Avenue Supermarts, TCS, Infosys, Reliance, etc. are underwhelming. This indicates equities are not priced rationally based on current earnings. Certain indicators are pointing to a cyclical growth slowdown, fading urban pent up demand, tight monetary policy, a moderation in credit growth, negative real rural wage growth, sluggish private capex, and soft external demand. This is not from my side, this is from RBI's report. So the growth momentum continues to be soft. Urban consumer mood and rural segment uh, demand showed a downtrend. Domestic fund inflows have continued to support the Indian markets. There is a avalanche of selling by FPIs switching to China. Roughly, I think 80 odd thousand crore they have sold, but domestic investors have put in their support to the market. So the interest of the domestic investor has remained unshakable in this market. What they are choosing is the narrative of India's high growth potential, rising per capita income, return on equity, returns which equities have given in the last 1 or 2 years, good balance sheets of the companies, and it seems that the geopolitics, supply disruptions, poor corporate results, climate change, etc., as are not viewed as a problems or viewed as a problems for future. High valuations leave a very thin margin of safety for investors, and this is being seen in the reaction to result of stocks. High valuations, which have all the positives priced in, are not able to sustain when results are weak. Reaction to results of these stocks is sharp. Nestle fell 20%, Bajaj Auto also fell 20%, DMart came down 30% from the top. For the outlook to remain favorable, buoyant domestic demand will be critical, especially as India enters its festive season. Bajaj Auto, in their past results earning call last week, said that the festive season began on a muted note with sales lagging expectations. For full fiscal year FY25, domestic two-wheeler industry growth is pegged at 5%, while people were thinking that it will be double digit. Two wheelers are mass market products. Their uh, This run against expectation built around healthy monsoon rains and recovery in rural demand is a big challenge. Soft demand can also impact consumer goods sector. So all the people who sell white goods will be worried and they will be giving big discounts to clear off their inventory during this festive season. Economic fallout of geopolitical conflict could be very high in a time of such high economic codependence. Disconnect between economy and equities increases the chances of sudden jump in financial market volatility and a correction in asset prices. We live in a mistrustful, fragmented world where national security is the top concern of many countries. Now, coming to weekly data, Nifty was down 0.44, and this was also due to the momentum which came on Friday. Otherwise, it would have been around more than 1%. Bank Nifty was positive. Gold went up. Silver also around 4%. Crude oil corrected because I don't think there is much of a issue in terms of Middle East. Natural gas was also corrected. It had gone up because of the hurricane season. Now it is correcting. Dollar went up. USD INR uh, came down, so the rupee strengthened. India's 10-year bond yield was generally at the same level. NSE market cap also came down more than the Nifty correction. That implies that the broader markets were also correcting. Market-wide position limits are high, which indicates people are taking a lot of positions. Dow, Nasdaq, and S&P 500 were up nearly 1%. So US markets were positive. Coming to US markets, US indices notched a 6-week winning streak. Dow Jones surpassed 43,000 mark for the first time. The advance was driven by a combination of strong earnings, rotation into all corners of the market, robust retail sales, and a hope that Fed will be able to deliver a soft landing. TSMC and ASML came up with contrasted results. So, firstly, after ASML results, all the semiconductor and AI related stocks came down, and after TSMC's results, they all went up, back up. Financials continued to advance after Morgan Stanley, JP Morgan, and Goldman Sachs delivered strong results. Finally, Netflix topped profits and subscriber growth expectations. So, if you see the US 10-year yield here, it was on a downward trajectory. Now it is going back up. It has already reached the 50 EMA at 4.08, and it is looking stronger now because the expectations of rate cut have been slightly subdued in the US also because of strong economy. So they are not expecting a 50 basis point cut in November. Dollar index also resumed its rally, took support at this 100 odd level, and now it is going up. Let's see if it can cross this downward trending trend line. Brent crude corrected to around 73 level. So there is lack of momentum because there is lack of expectations of a low demand. Gold is on a different trajectory now. It crossed $2,700 to an ounce, and now it is making an all-time high. And with if the equities are also doing well and dollar is also doing well, and gold also doing well is very surprising, but that is how it is. Copper corrected because people are still slightly apprehensive about China's response and all. It had gone up on the Chinese stimulus, but has now corrected. Nasdaq was kind of a doji, flat last week, but Dow Jones crossed 43,000, and now it is looking very strong as the broader markets have started performing better. India VIX is generally didn't move much, is at around 13 level. So despite all the volatility, there is no volatility in India VIX as such, which is pretty surprising as actually. Indian government bond yield is that stuck at that 6.8 level. So this is the range right now, but the trajectory is downwards. Once there is a clarity on rate cuts in India, then it will correct. Now, if you see Nifty here, uh, it has made a third week of bearish candle, and at even at weekly level, it is now coming to 20-day moving average or 20 weekly moving average. Now coming to daily chart, so if you see this, it is forming a kind of a head and shoulder. Now, this was forming, but it got slightly pushed back on Friday. But if it corrects a bit more, then this head and shoulder would be formed. Now, likely depth of this from the neckline is the length of the height from the neckline of the head. So it is roughly, if it really plays out technically, it should go down to around 23,400 level if this is followed. But the trend is down on the daily chart. So if you see, it is this 23,450 level becomes critical because that is the 100 EMA. Now let's see Nifty 50 on Fibonacci levels. Uh, this rally has corrected around 61.8%. So it was uh, it was hoped that after 61.8% correction, it should bounce back, but it went down, and then on Friday it bounced back very rapidly. So we'll have to see, because if this 61.8% retracement or 24,800 is not held, then it will go down completely to the complete rally. So as per this, 24,000 becomes possible, and it is very precariously poised at the 100 EMA. So we'll have to watch this. Coming to hourly charts, so if you see here, uh, it uh, throughout the week it was trending downwards. Then on 18th it became oversold, and even the PCR had gone to 0.65 level, and then it bounced back from there, which was mostly a short covering because there was no substantial uh, delivery based buying as such. So we'll have to watch this, but till the time it is below this 20 and 50 EMA on the hourly charts, it remains very weak. Nifty Bank was stronger. Uh, it had a bullish weekly candle, and it has held this 20 EMA. So this is looking much better. And on the daily charts also, it has gone below. It had gone below the 100 EMA, but has got support there. And on Friday, it it bounced back because of short covering, and also because of the good results of Axis Bank, and your expectations were that everybody else will come up with the similar kind of results. 100 EMA has been held. Uh, so 51,000 is a critical level which needs to be defended. Now, the index which was looking in momentum and now is floundering or kind of not getting momentum is now Nifty IT. It had gone up to an all-time high, but now because of the results and all, it is looking weak slightly. And you see the RSI is also going down. Now, HDFC Bank, if you see this daily chart, uh, it had corrected, then it bounced back. So results are kind of flat only, nothing great about it. So let's see which direction it goes. The positive thing is that there is an IPO of their HDB Financials, but that is generally all known and all priced in. So don't know which direction it will go, or probably it will just remain at these levels. But it has taken support at this 100 EMA. So, and the good part is that it didn't break this 1600 level. So that 1600 remains a decent support. And this at around 1700 it gets sold. Now Reliance had broken this support and had gone down below, and then it had because it had become kind of oversold, so it bounced back from there. But there is not much of momentum here in Reliance because of slightly weak results. So if this level breaks, then the next level of support would be somewhere from where this rally started, around 25, 550, etc. So that should be the next support. Now, the accident of the last week was Bajaj Auto, and see how much it has corrected. It has corrected nearly 30% from its top and corrected approximately 15% in a day only. And then on Friday, it made a kind of a doji. So, because too much of good things were priced in, and now you see how the RSI has corrected, it has become oversold now. So, there would be a bounce back, and after that, Let's see. It's a good company. Only thing is that the price had gone up too high and the valuations were too expensive to sustain these levels. Nifty Metal Index was looking up after the Chinese stimulus, but now is getting weakened because probably there is no clarity as such on base metals, etc. Midcaps couldn't really go up, but a candle with a long tail shows on the weekly basis that there was a buying, and so it didn't get sold off as such, and it is above the 20 EMA on the weekly charts. Similarly, with small caps, it made a kind of a doji, so it is not bad. It sold out, but I think buying came, so it has recovered as such. Now I'll cover three stocks today. First is Newgen Software. Uh, they did a revenue growth of 14.8% Q on Q, led by Q2 seasonality tailwinds and strong license wins, largely in APAC, that is Asia Pacific region. Operating margins too, with seasonality and operating efficiency expanded to 20%, 20.8%. Resilient business model backed by annuity business. That is the kind of support they provide. 30% is the part of business. ATS, AMC. ATS is annual technical support, which is basically used for hardware, and AMC is for software. It comprises 20% of the business. Software as a service is 10%. Sale of products, that is the software products they make, is around 18%, and sale of services is 22%. So this is their present business model. They do product license, implementation, annuity. Annuity is, that is annual income on uh, AMCs and ATS and SaaS. Management says that they would likely to do around 500 million aspirations over the next 3 to 4 years. That is roughly they are talking about is around 4,000 crores of revenue in a year. They are likely to do. That's what they're saying. Presently, they are at around 1,500. It is diversifying its target clients by way of insurance solutions, including payer insurance in the US to bag more deals, insurance and government verticals to see renewed focus, operating leverage to play out in profitability, and hence expect margin expansion of 113 basis point Q on Q to 21.9% for Q3 FY25. Continued growth run rate over the last 5 years, backed by banking sector coupled with customer upgradation transition towards SaaS, will likely deliver strong momentum in the medium term. Company is heavily investing in R&D, building capabilities around the existing products, new product lines to penetrate into different geographies, and translate into small deals into uh, large ones. So, trying to increase the deal sizes from their existing clients. So, let's see their profit and loss. So, if you see, they did 14% revenue growth Q and Q in dollar terms and 14.8% in rupee terms. Year on year, roughly around 20%. So among the IT companies, they were among the better lot as such. Uh, EBITDA was up 74% uh, Q on Q, and EBIT was up 87%. EPS was up 47%, and margins, EBIT margins improved 808 basis point. That is from 12.7, it has come to 20.8 Q on Q. But to see uh, the year on year also, they have improved their margins because operating leverage is playing out. They are expected to do a revenue of approximately uh, this is in millions of rupees. So 1890 crores and around 2300 crores in FY26 and 27. And the PAT is likely to be around 379 crores and 468 crores in FY26 and FY27, with a year on year growth of around the estimate has been increased. So with their performance, so they're likely to do 22.2% year on year growth in FY25 and 22.1 percent growth in FY26. So that is pretty strong in terms of other IT companies which are mostly flat. And EPS is expected to grow 20 to 25%, 26%. over the next 2 years. Uh, and EPS is expected to be around 26, sorry, uh, which is expected in FY26. So if you see here, the margins are improving. All the margins are improving. Uh, they are likely to do a EPS of around 26. So at presently they are for FY26, they are valued at around 49 times, which is slightly expensive. So most of the good news is in the price. So this is their growth rate. Revenue they expected to do 20%. EBITDA around the higher 20s. EBIT again are higher 20s. PBT 20 plus. PAT, profit after tax, also 20 plus, and EPS also 20 plus. So why I've covered this is among the better growing IT companies uh, because of smaller size and the kind of work they are doing. So if you see on charts, revenue grew 14.8% Q on Q and 23.2% year on year. License business grew 55.7%. That is the products they have sold and all that. Annuity revenue, that is the AMC, etc., grew 16%. And operating margins grew by 808 basis point Q on Q. So this is their average. So it has done well in the last quarter. So they are into various geographies: India, uh, Europe, Middle East, and Africa, EMEA, Asia Pacific, and USA. So this is how they get their revenues from these geographies. So basically, India, Europe, and USA are the key verticals in which they are in banking and financial services 72%, government and PSU 6%, insurance and healthcare 15, and others 7. So this is how they are doing it. Now, this the sale of annuity is roughly 60% of their revenues. Sale of products, IT products, is around 18%, and sale of service is around 22%. So they are in IT products, IT service, and then in AMC, ATS, etc. Also, so they are covering all three verticals of IT, and this is their share of revenue along with that. So what happens is annuity revenue, if it is larger scale, AMC, ATS, etc., gives you kind of a uh, uh, revenue visibility over a longer time. So revenues are not volatile because it's an annual affair. Now, coming to their charts, it's on a constant upward trajectory, and it had gone to around 1500 levels. From there, it had corrected now. So, at 26 rupees EPS in FY26, so at 50 times, it should reach around 1300. So that would become expensive. So anytime you get it closer to the 50 EMA at 1200, that is where there is an opportunity, and below like that, because because of good results only the stock went up, and now it is correcting because there is generally correction now. So at every dip, this is a good stock to hold for 2 3 years in terms of IT performance. Next stock I'll cover again. It's an IT company, Mphasis. Uh, Inline performance for the quarter, segment wise, banking and financial services grew by 3.6% Q on Q, insurance grew by 2.3%, and TMT, that is technology, media, and telecommunications, grew by 6% Q on Q, while logistics and transportation was down 1%. Deal pipeline remains strong, well distributed across verticals, with 35% being AI led deals. Uh, TCV win was 207 million. TCV is total contract value, with 88% of the deal wins in the next generation uh, services, which is basically related to IT products. Next generation data services enables efficient and seamless access, unification, migration, analysis, integration, and harmonization for organizations at every stage of data maturity. So this is basically related to digitization of the company's data which they do. The focus is on driving investments to drive business growth with broadly stable margins. it expects adoption of AI among enterprises to have similar trajectory like cloud adoption. There has been some improvement in TCV to revenue conversion with some pickup in volumes of mortgage related deals. The near term growth would be driven by banking and financial services and TMT, which is technology, media, and telecommunication verticals. Deal pipeline remains strong, well distributed across verticals. But the primary thing is that they are a banking and financial services focused IT company. And if you see the US, the results of all the large banks, uh, Morgan Stanley, Goldman Sachs, JP Morgan, etc., have been very strong. So it gives a good visibility for the IT companies which are focused on banking and financial services. Let's see the results. Q and Q, the revenues were up around 7.9%. EBITDA margins were slightly up. EBITDA was also up, same 8.8%, and earnings EPS was up around 8 rupees. So they are expected to do around 108 rupees EPS in FY26. So considering that the present price of around 3,000, they are kind of fully priced. Rest all parameters are improving for them. So they are on a upward trajectory. Revenue growth picked up sequentially, so they were up 2.7% Q on Q. Headcount was flat sequentially, so they didn't add any employees in Q2, but they reduced their number of employees. EBITDA margins improved, so EBIT margins improved, so to 15.4. So that means they are making more money, and the greatest most of the part of their business is coming from US, America, 80.7%, and then Europe, etc., and India and rest of the world is lesser. See their chart, similar charts for all IT companies, they had dipped, and now after the results, they have started going up. So it bounced back up from to the 3,000 odd level again after the results were considered to be good. So this is a stock to be bought on all dips because price is mostly it is in the price around 100 rupees EPS 30 times it is adequately priced. Now I'll talk about Waaree Energies. This is the IPO which is coming now next week, starting on Monday, I think. Uh, it is India's largest solar PV module manufacturer with an installed capacity of 13.3 gigawatt. 1.3 gigawatt capacity commenced at Indo Solar facility post June 24, up from 4 gigawatt in FY22. It has substantial order book of solar PV modules, including 16.66 gigawatt for domestic and export orders, franchisee orders, and 3.75 gigawatt of orders for its subsidiary, Waaree Solar Americas Inc., located in United States. Plans to set up 5.4 gigawatt solar cell manufacturing facility by FY25 plans and a fully integrated 6 gigawatt manufacturing facility to start operations by FY27. I'll explain these things. Partly financing the cost of establishing a 6 gigawatt ingot wafer solar cell and solar PV module manufacturing facility in Odisha by use of the IPO proceeds by way of investment in wholly owned subsidiary Sangam Solar One Private Limited. It operates 5 manufacturing facilities right now: Gujarat, Surat, Tumb, Nandigram, Chikli, and Uttar Pradesh, Noida. Solar PV modules are currently manufactured using multi-crystalline cell technology, monocrystalline cell technology, and emerging technologies such as tunnel oxide passivated contact, which helps reduce energy loss and enhances overall efficiency and increases the life of the module. India's installed solar capacity will increase from 82 gigawatt in FY24 to 198 gigawatt. That is more than doubled in next 4 years in FY28. It recorded a CAGR of nearly 99.8%, 276.7%, and 300% in revenue, EBITDA, and PAT from FY22 to FY24. So you can see the growth potential. Now we must understand what is the issue. Now, solar module manufacturing value chain in India. Now you must understand that most of the guys who are in this technology, who are making the solar modules, are at this stage. To make a solar modules, you require solar cells, which they are importing. Only very few, like Premier Energies, are making solar cells, and now Tata Power is getting into this. To make a solar cells, you require wafers, which are made from ingots, and for that you require polysilicon. Now, for all this, this is what they are talking about, that they will make ingot wafer. In FY27, they are planning to make a project for that. Right now, 90% of these cells, wafer, ingots, polysilicon is imported from China. So there is a total dependence on China for this. So this is what is part of crystalline silicon technology used in solar voltaic PV systems globally, including in India. So we have a big goal of 280 gigawatt of solar capacity. So there is a lot of scope. Everybody will not. So everybody will get orders. 80 to 85% of solar modules need to be imported because domestic production capacity is insufficient to meet demand. And those who are making solar modules in India also are importing cells, and the domestic production of cells is also not there. India lacks a manufacturing base for polysilicon ingots and wafers. Uh, Now, what happens is silicon is extracted from sand, purified, heated, melted into a high purity liquid, then solidified into a silicon rod or ingot. Then wafer is a thin glossy slice of silicon rod which is cut using specific diameters. So firstly you have to make ingots, then from that you cut wafers, and with wafers you make cells, and with cells you make modules, and then you give it to the company. So you must understand in this complete supply chain who all is at what stage. So most of the companies are importing these components at high cost, and moment if there is a conflict with China or the government increases duties, etc., so their cost will go up. So that is the risk. But right now, government is looking other way because they want to promote this solar stuff all over in India. Now coming to their income statement, their revenue grew 68.8% to roughly around 11,000 crore, 11,400 crores. And in first quarter only, they have done around 3,400 crores. So they are expected to do around, in my view, they would do around 15,000 crore in FY25. So profit gross margins are improving, and now they are nearly 26.3%. EBITDA margins are also improving now as they get, because operating leverage will come into play as they operate more and more. And EPS is now reaching, should be around uh, 60 to 70 rupees now for FY25. Last year it was around 48. So it is pretty cheap. ROA, ROCE, return on equity, all are becoming higher now and improving. Gross margins, EBITDA margin, net profit margin, etc., are also now improving. Uh, Fixed asset turnover is good, so that means they are becoming more and more efficient. And this is for FY24, so it will improve further. There hardly any debt because I think their cash flow situation is good, and other valuation ratios are also decent. So they are coming at around 30 times FY24 earnings, which is steal actually. I wish I could have got it, this IPO by in QIB format, which a lot of these funds etc. have got it. So there will be huge demand. Now they had 2 gigawatt in FY21 manufacturing facility, increased it 6 times to 12 in FY24. In FY25, they are adding a 5.4 gigawatt cell manufacturing facility. If you see the chain, so they are adding this 5 gigawatt of cell manufacturing facility, and then in FY27 they want to add a 6 gigawatt of ingot wafer facility, integrated facility in Odisha, for which they have got a PLI incentive for that. So this is key, and the other facilities are as it is improving. Order book is pretty big, so that is not a problem for them. As to how much they can execute is the issue. Now, if you see all India installed power generation capacity, presently in FY24, it's at F442 gigawatt. out of which 243 is thermal, 8 is nuclear, 82 is solar, wind is 46, and other renewables are 63. Now, solar from here is likely to grow to 198, so nearly double from here. Similarly, and that's the biggest area of growth which will be there, which will be in solar. Now, key domestic solar module manufacturing with capacity in June 24 installed capacity wise, if you see, they are Waaree Energies is 3x of the nearest competitor, Adani, Mundra, etc., Renew Power, Vikram Solar, which is again now going to come up with an IPO shortly. Premier Energy, which had come up with an IPO, etc. So they are 3x of their present competitor, nearest competitor, and they're supplying things to US also, and part of that they have a subsidiary in US also. So peer comparison, if you see, they are coming at IPO price of 1500. In my opinion, it will list not less than 3000. Take it. If it lists below 3000, buy it. Presently, they are coming at 33p. Uh, the nearest competitor is Premier Energies, which has got a present CMP is 1136, and they are at 129p. So you can see what is the scope available and all that. So there will be huge demand for this IPO. Now let's see the Premier Energies chart. This is a hourly chart. We got recently listed in September. So it has been now in this range of 1250 to 975 odd, but it has not fallen right now. So wait for the results. If the results are good, it should also go up. Uh, this one, but this is the easiest competitor for this. So they have a long revenue visibility, at least for next 4 5 years. There are enough demand for them because you've seen what is their installed capacity and how much uh, is the requirement. I finished. We'll take questions now.